Hello, everybody. This is Bennett Tchaikovsky. We're kind of getting near to the end of some of our questions before we get into some bigger questions, but my disclaimer and copyright notice for this earnings per share video. The information and opinion in this presentation are those of myself only and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I'll make reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright that I'm referencing in those third parties. Okay. So our last one for this series right now, but I'm going to make actually a few more videos on this, which are going to be a little bit more intense, is this question 1.5. And let's go ahead and take a look at this over here. So Pearl Enterprises issued at par 60 $1,000 8% bonds, each convertible into 100 shares of common stock. Pearl had revenues of $17,500 and expenses other than interest and taxes of $8,400 for 2032. Assume that the tax rate is 20%. Throughout 2032, 2,000 shares of common stock were outstanding. None of the bonds were converted or redeemed. First thing they're asking us to do is to compute diluted earnings per share for 2032. Now, the one thing that we want to remember is that I've got to be very careful about anti-dilutive securities. So before I go through and compute diluted earnings per share, I want to compute basic earnings per share. My basic earnings per share is going to be my net income less any preferred dividends divided by my weighted average shares outstanding. Okay. Now, to compute my net income, right? My net income is going to be right over here. I've got net income, excuse me, I've got revenues of 17,500. I have expenses other than interest or taxes. That's really important. My expenses were 8,400. And then over here, the one thing it didn't tell me is interest or taxes. So how much interest did I pay on these bonds? Well, I had 60 bonds at $1,000 face value. And so the total base amount of these bonds, $61,000 bonds at 3,600. And these are going to be at 8%. So my interest expense, $61,000. Now let's, hold on. Now this is actually giving me something wrong. Hold on. 60,000, sorry. 60 bonds at $1,000 face value per bond gives me $60,000. Something didn't look right. So over here at 8% interest, over here, my interest expense is going to be $4,800. So my interest expense, okay, essentially right over here, this is going to be 4,800. So my net income before income taxes is going to be 17,500 minus 8,400 minus 4,800, or it's going to be 4,300. Less income taxes, this is going to be 20% or 860. So my net income after tax is going to be here at 3,440. So my net income is 3,440. My weighted average shares outstanding was 2,000. So under Part A, my basic EPS is going to be $1.72. Okay. Now, when we do our fully diluted, what is this really going through and assuming? So fully diluted, it's basically net income minus preferred dividends But what if we converted the bonds? What would happen? Plus, so if I converted the bonds into common stock, then in reality, I wouldn't really have to go through and pay this interest expense. So I'm going to basically be adding back interest expense. But what's important here is this interest expense is going to be net of tax. And why is that? Because my net income here is really implied is after tax. So if I just took 4,800 and added this back, that's not going to be the same number. I need to basically add back I got to add back the interest expense, but less that tax component. What does that really mean? Well, if I'm getting a deduction here for 4,800 pre-tax, if I had a 20% tax rate, so the value of this deduction is really going to be 3,840. Or another way we can do this is basically say, okay, 4,800 by basically my interest expense add back net of tax. This is really going to be 4,800 times 0.8, or that 1 minus 0.2. So here, 4,800 times 0.8. So my new net income, or my net income or diluted, is going to be at 72.80. So over here, my basically under fully diluted, it's over here. So this is going to be here at 72.80. Now, I then need to kind of go through and say basically my weighted average shares outstanding plus the bond conversion. Okay, for this one here, right, in terms of this bond, well, how are these convertible? Well, each bond is convertible into 100 shares. So over here, my bonds, shares to be issued per bond. So the total shares to be issued, if converted, is going to basically be, and again, it did this to me, 6,000 shares. Okay. So now this is going to be 2,000 plus 6,000, or a total of 8,000. So my fully diluted EPS is going to be right over here at 91 cents per share. So we are going to basically assume that the bond is converted because it is in fact dilutive, meaning my earnings per share is going down. I'm just going to pause one moment. Okay. So now let's go ahead and look at part B. Basically, it says assume the same facts as above, except that 60 of the bonds were issued on 9/1/32 rather than in 2031. And so basically compute our diluted earnings per share for 2032. Okay, so we have to kind of go through and do the same exercise. We have to say revenues, expenses, and then we have interest expense. So our revenues are not changing because the facts are the same. My expenses are not changing. However, my interest expense is going to be different. And this is for part A. Now for part B, if 4,800 is the annual interest expense, then the interest expense for 4 months, or September, October, November, December, right? So this is going to be 4,800 times 4/12 or 1,600. So my right over here, my interest expense is going to be 1,600. So my net income before income tax is going to be 17,500 minus 8,400 minus 1,600 or 7,500 less my income taxes at 20% gives me net income after tax over here of 6,000. So kind of doing the same equation here. So this amount here is going to be 6,000. My weighted average shares outstanding is still 2,000. Because remember, for basic, they didn't convert, so we're not worried about that. So my basic earnings per share is going to be $3 per share. Now, for the fully diluted, and again, this is for part B. Okay, for the fully diluted, right, what's going to basically be the difference? Well, I'm going to have to go over here and add back that interest expense. So I add back, and when I add it back, it has to be net of tax. So this is going to be over here, my interest expense. So this is 1,600 times 0.8 or 1 minus 0.2. And I get 1,280. So my net income for diluted is also going to be 7,280. Oh, yikes. Is that right? I guess it's because we're okay. So right over here, this is going to be 7,280. Okay. Now, when it comes to my weighted average shares, right, this 2,000 is not going to change. However, when it comes to this, right, this 6,000, right, this is assuming for the part A was for the full year. Now, if we're issuing the bond right over here, basically now go through and assume that it was basically issued on 9/1/32, then basically we need to multiply this value here by 4/12 because it would only be outstanding similar to the interest, right? So this is going to be basically the total shares that would be issued. And then we're going to multiply this here by 4/12 or from September to December of 2032. So over here, I'm going to basically take 2,000 and I'm going to add in the 2,000. So my basic earnings per share here is going to be at $1.82. So again, they are dilutive, so we have to go through and include them. Okay, let's take a look now at part C. Okay, so part C, assume the same facts as part A, except that 20 of the 60 bonds were actually converted on July 1st, 2032. Compute diluted earnings per share for 2032. So the one thing I'm going to change on this to make it a little bit more interesting is I want to change this here to be, let's call this October 1st. Okay. And the reason why I want to do that is, you'll kind of see momentarily is it'll make the question like a little bit more unique. Okay. So part C, right? My revenues are going to be exactly the same, right? My expenses are going to be exactly the same. But now when it comes to the interest, it's going to be a little bit different. For my interest, right? So basically over here, want to split this up. So I'm going to have 40 bonds at $1,000 face value. So I have a total here of $40,000 of bonds. And at the same time, I have 20 bonds at $1,000 face value. For a total of 20,000. So this was outstanding the full year, and this was redeemed, converted on 10/1/32. Okay, now when it comes to the interest expense, right? Whenever I see an interest rate, it's always going to be an annual rate. So my interest expense over here, we've got $3,200, but if this over here was converted on 10/1/32, then the bond during the year was outstanding for 9 months. So I had to go through and pay basically 9/12 of interest expense, or from January 1st through September 30th. Okay, so right over here. So my actual interest expense on the non-converted bonds was 3,200. My interest expense on the converted bonds was 1,200. So my total, my net income before income taxes is going to be 17,500 minus 8,400 minus 3,200 minus 1,200, or a total of 4,700. Less income taxes. My income taxes here were basically going to be at 20%. So my net income after tax is going to be 3,760. So why does that seem to be off? Just give me a moment. Sorry about that. Okay. So over here, my basic earnings per share is going to be my net income of 3,760. Now, my weighted average shares outstanding are going to be a little bit different, because over here, this is the 2,000 originally outstanding, but here these bonds actually converted, right? And the bonds essentially convert at a rate of 100 shares per bond. So here I have 20 bonds, and this is converting at 100 shares per bond. Okay, so this is converting at 200 shares, right? However, or 2,000 total shares. However, I need to make an adjustment because these 2,000 shares were not outstanding for the entire year. So I need to basically multiply this by 3/12, or to basically October 1st through December 31st, or to get to 500. So this is going to be 2,500. So my weighted average, basically, so my basic earnings per share is going to be a little bit more than $1.50. Okay, now I have to go over here and now do my fully diluted. Okay, so really what I'm kind of going through and doing is I'm basically saying, all right, my net income after tax was 3,760. I need to then add back my interest expense on both of these. Now remember, when we do this, right, we only, on the real one, they were only outstanding for these were only going to be outstanding for 3 months. But when we have this over here, we have to assume that these converted over 9 months, that in fact it converted, that 9 months prior. So we're going to add back both interest expenses on an app, basically on a net of tax basis. So here, basically the interest expense non-converting, this is going to be 3,200 times 0.8. This is going to be 1,200 times 0.8. So now basically my net income for fully diluted, excuse me. So my net income for fully diluted will now be 7,280, and it's magically coming up to be the same number. Okay. So that means 7,280. Now, in terms of my weighted average shares outstanding, right, it's going to be the 2,500. But then what I have to go through and do is say, well, I have 40 bonds, right? So that you have these 40 bonds that would have been converted for the full year at 100 shares per bond. So we have 20 bonds at 100. And then 2,000 is for the full year, but I have to multiply this by 912. So basically the months where it wasn't outstanding, right? So this is going to be January 1st through September 30th. Okay. So over here, then the shares I'm going to be adding back and the diluted is going to be over here at essentially is going to be at 5,500. So this is going to be 7,280 divided by 8,000, or I'm going to get over here 91 cents, which ultimately, which is what's kind of interesting about this, is that this is essentially, this is basically the same result that we got up here. And just give me a moment on this. Okay, so again, when we're doing these questions, they just kind of worked out that way to be mathematically, but obviously the basic is different. But when we go through and do this, we want to essentially go through and to make sure that we're actually computing the numbers. Always compute the basic and EPS first, then do your fully diluted. Make sure that they equal out. And I'm going to see you on the next video. Have a great one. Please remember to like and subscribe, and I look forward to seeing you on future videos. Have a great day.